Okay. Good morning, everyone. So today is our second session on Ind AS 110 that deals with consolidation. I hope you could go through those notes which I had discussed with you in the last class. And I also hope that you could have a look at the problems that I requested you to go through. Okay, so today we will start with some questions and then move on to certain additional adjustments. Okay, so let us start today's session. Just give me a minute. Okay, yes. So we had seen in the last class up to analysis of reserves of the subsidiary. And at that stage we had ended. I had told you to solve two questions. I hope you did questions 4 and 5. So that should kind of make the things clear. NCI can have a negative value. That was not the case in AS, because there it was to be taken as adjusted against the majority shareholder. But here there is no such requirement. NCI can have a negative value. You can disclose it as a debit balance. Here it is as a part of equity. Okay. So with that background, let us come to actually solving one full-fledged question just for our understanding, okay, of the process that is involved. Okay, so we start to solve question number 6. Okay, given below are the financial statements of P Limited and Q Limited as on 31st March 20X1. So as you are aware, the schedule 3 Ind AS is in line with how the financial statements are presented outside India as well. So therefore, we are having assets first and then followed by the liabilities. Okay. So you are given assets of P and Q, property, plant and equipment. Financial assets, you have non-current investments, loans. Current assets, you have inventories, and financial assets, you have trade receivables and cash equivalents. Equity and liabilities, you have share capital, other equity, non-current liabilities, current liabilities, short-term provisions, total equity and liabilities. Yes. Then you are having notes to financial statements, reserves and surplus. You are having general reserve and retained earnings. Inventory breakup is given of raw materials and finished goods. On 1st April 20X1, so you are given the balance sheet as on which date? You are given the balance sheet as on 31st March 20X1, and the next day itself, P Limited acquired 70% of equity shares of Q at rupees 36,000 lakhs. So this is your purchase consideration. Okay. The company has adopted an accounting policy to measure non-controlling interest at fair value. So this is NCI at fair value. That means the goodwill is full goodwill method. Accordingly, the company computed the full goodwill on the date of acquisition. Even if this line was not given, we would understand. Shares of both the companies have a face value of 10 each. Market price per share of Q is rupees 55. This is needed for the fair value of non-controlling interest. We'll calculate that. Entire long-term borrowings of Q is from P. The fair value of net identifiable assets is rupees 50,000 lakhs. Prepare the consolidated balance sheet as on 1st April 20X1 as per Ind AS 110. As per Ind AS 110. Okay. So with this, let us start to solve. So I had shared with you some formats. I'm just pulling out those formats only. Okay. Now, typically, what will be your approach in the exam? Okay, how you will start to solve such questions in exams. Of course, you won't get this is a very simple question, aisa to nahi aayega, but the overall flow will be like this. The moment you see the question, the moment you see a consolidation question, the first thing that you do is draw the consolidated balance sheet. Draw the Sir, apne ko kya malum? See, the only two additional things that may come is One, it's either a goodwill or a capital reserve. So you make a provision for goodwill. See, since this is a class, I know what is going to come, but in your exam, you won't know. So write goodwill. Capital reserve anyways would go under other equity. So make a provision there as well and keep it. Leave one line. Okay. In your exam, it doesn't matter. All right. Then coming to equity, you will have another item known as non-controlling interest. So keep space for these two items. Rest all, whatever is there in the balance sheet, just copy that. So your formats are at least ready. So the first thing is your consolidated balance sheet format should be ready. Okay. The next thing is note number 1, that is assets and liabilities. Here we will be recording all the assets, all the liabilities without making any adjustments, Coming to the question now, look, P Limited acquired 70% of equity shares at 36,000 lakhs. Clearly, this entry is not passed in these financial statements. This entry is not passed because this is on 31st March, the day before. Immediately next day, the acquisition is happening. So P Limited acquires the investments. So what will be the entry? The entry in P's books will be investment account debit to bank. So therefore, if you come to your non-current investments, this is currently appearing at 10,000. This is going to undergo a change. Okay, so now non-current investment, sorry. It's appearing at 5. So 5 will undergo a change and become 41,000. 36 plus 5. And the corresponding impact is your cash and cash equivalents will reduce by 36,000. So therefore, you are having your fresh balance sheet as on 1st April, immediately after acquisition, to reflect these figures. Non-current investments at 41 and cash equivalents at 2,000. So this is the adjustment that you will do in this case. And now with this balance sheet, we will come to our format. Okay, just a second. Yes. Okay. So now the second thing that you will do is record all the items of assets and liabilities as it is from the question. Don't read any even further problems that have multiple adjustments. Don't read any adjustments for the purposes of note number 1. Note number 1 is plain and simple recording of assets and liabilities as they are, excluding equity share capital, reserves and investments. So that is what I will be doing. Okay. So let us start. PPE 1,07,000 and 44,000. So just write that. In all the problems you will see, we will be following the same approach. Okay. Investments, here it is appearing at 41,000. But actually out of 41, 36 is the investment in subsidiary. So we will write 41 minus 36. So it comes as 5,000. And then the other investment is 1,000. Then you have loans at 10,000. There is no other loan for Q, loans and advances. Inventory is 20 and 10. The breakup is given of the inventories. So we will give the breakup 10 and 5, 10 and 5. So this makes it 20 and 10. Okay, next. Trade receivables 8,000, 10,000. Cash and cash 2,000 and 1,000. Share capital, other equity we won't consider here. Financial liabilities are there. We will consider that. Long-term liabilities 30,000, 10,000. Deferred tax was 5,000 and 1,000. Long-term provisions also 5,000, 1,000. 6222 trade payables and short-term provisions. Okay. So this is the first step that you will do after having the draft financial statement, the balance sheet ready. Okay. Adjustments and all, nothing, just copy the assets and liabilities as they are. All right. So once this is done, are you all done? I hope you have these prints with you. Okay. Because if we start doing it one by one, it will take a lot of time. And that is, time is a resource which is never available in plenty. Okay. So are you done? Shall we proceed further? Yes. Good morning. Good morning, Rashmi, Manini, Srishti, Sumit. Where are the others? Soham, Shailendra, Kaushiki. Okay, so this is done. Let us then move on to the next one. Equity share capital of the parent is what is going to come. So parent's equity capital is 20,000. Somewhere they have given that it is face value of 10 rupees per share. So write that down. 2,000 equity shares of rupees 10 each, fully paid. 20,000. 20,000. Okay, so that takes care of equity share capital. Reserves and surplus, we will write the parents reserves and surplus as well as the subsidiary if there are any extra. But here both the cases we have only general reserve and retained earnings. So let us just write that. All these amounts will flow from working note 1. So we will be solving working note 1. Okay. So working note 1 deals with consolidated other equity. Working note 1 deals with consolidated other equity. For each item of reserve, you will have a separate column. So securities premium, general reserve, retained earnings. Okay. Each of these items you will have a separate column. Okay. And the first thing you will write here is standalone from P Limited as on the date of consolidation. So the standalone reserves are 1 lakh and 20,000. So let us copy and write it as it is. 1 lakh and the other one is 20,000. And the other one is 20,000. Okay, so that takes care of the consolidated other equity. The next working note that you will be preparing is your cost of control account. Okay, so here we will eliminate what? The investment in the subsidiary. So 36,000 was subsidiary, 5,000 was others. So this is what will be eliminated in the COC account. Okay. So come to your cost of control account and write here to investment in Q Limited. 36,000 to investment in Q Limited, 36,000. Okay. What is the stake which you have acquired? You have acquired a 70% stake. So always make it a point to write the stake as well, So you don't have to refer to the question time and again. Okay. So this is your cost of control account. So since this is 70%, your NCI is 30% stake. And always write which method you are following. So which method followed? NCI at fair value. NCI at fair value. Okay. So you are clear about these two things. One is the stake and the other is your method used for valuing NCI on the date of acquisition. So now let us move to the next part. We are done with recording 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. We are also done with accounting assets and liabilities. Okay, so now we are done with the inventories also. So now what is left is reserves and share capital. We have also recorded equity capital of the parent as well as the other equity of the parent. So we are now left with only two things, that is equity as well as reserves, for which we will have to do the allocations. Equity will be going to the parent as well as the NCI, 70% and 30%. Reserves also will be distributed accordingly. Okay, so now let us start this game. Okay, so now let us distribute the equity share capital. This is how much? What is the equity capital? 10,000. So 10,000 into 70%, 7,000 will come here. The balance 3,000 will go to NCI by equity share capital. 10,000 into 30%. 3,000 goes to your NCI. Okay, so that takes care of equity share capital. So we have done this. Now only thing that is left is other equity, or what you call as reserves of the subsidiary. So we are given this data. On the general reserve is 30,000 and 10,000. General reserve is 30 and 10. So let us proceed to do the analysis of the reserves. So working note 2, working note 3 is done. Working note 4, analysis of reserves, other equity. So here the first one is going to be your general reserve. What is the balance on the date of consolidation? 30,000. So general reserve is 30,000 as per balance sheet of S Limited. As per balance sheet of S Limited. Okay. We are preparing the balance sheet immediately after purchase of shares. That means this is the balance sheet as on the date of acquisition itself, practically speaking. And therefore, all these profits have been earned prior to the date of acquisition. So therefore, all these profits are nothing but pre-acquisition profits. Okay, sorry, not S, it's Q. Thank you. Balance sheet of Q Limited. Okay, so all the profits are pre-acquisition. None of it is post-acquisition because we are practically preparing the balance sheet on the date of acquisition itself. Okay, so general reserve we will write here as and not here, here, entirely pre, since it is on date of acquisition, since it is on the date of acquisition. Okay, so with this you just have to split it between the parent and the NCI. In what ratio? 70%, 30%. So this gives you 21,000. This gives you 9,000. Where am I going to record this? Entirely it is pre, since it is on the date of acquisition. So this will go to cost of control account, that is working note 2. That is working note 2. And where will this go? NCI account, that is working note 3. Okay, so this effects we can give immediately. So by pre general reserve from working note 4, 21,000 by, see, for NCI it actually doesn't matter whether it is pre or post. Okay, because unko to share se matlab hai. By pre general reserve 9,000, by pre general reserve 9,000. Okay, once this is done, we move on to the other one, that is retained earnings. Again, this is also entirely pre, since it is on date of acquisition. Since it is on the date of acquisition. All right, what is the balance? Balance is 10,000. Balance is 10,000. As per balance sheet of Q Limited. Split this up between P Limited and NCI. 70%, 30%, 7,000, 3,000. So this will go to cost of control, working note 2. This will go to NCI account, which is working note 3. Okay, so once this is done, by pre-retained earnings, working note 4, 7,000. Sorry, this is NCI, right? So this will be 3,000 pre-retained earnings, 7,000. 7,000. Okay, are we done? Is it clear so far? Is it clear so far, everyone? Am I too fast, too slow? Any doubts? Done. Okay, fine. Good. So once this is done, we move on to the next part. NCI is measured at fair value on the date of acquisition. We are on the date of acquisition. So therefore, NCI's fair value, let us calculate. To balance carried down. How many shares are there? 1000 lakhs are there. So 1000 lakhs means 300 lakhs will belong to the NCI. 700 lakhs was taken. So 300 lakhs. 300 lakh shares. And somewhere they have given the fair value to be rupees 55 into rupees 55 per share. So 300 into 55, this gives you 16,500. This gives you 16,500. Okay. I have a query why investments and cash are considered at 5,000 and 2,000. See, simple, no? See, when you are given this balance sheet, in this balance sheet that was given, acquisition had not yet happened. This is as on 31st March 20x1. The acquisition has happened on the next day, that is 1st April 20x1. So you have to give the effect of purchase of this 36,000. So effect of that purchase is going to be in the standalone books of T Limited, investment account debit to bank. So that is why this investment from 5 will become 41 and cash will reduce from 38,000 to 2,000. Cash will reduce from 38 to 2. See, P Limited is acquiring a stake in Q does not mean 36,000 will go to Q Limited. No, 36,000 will go to the shareholders of Q Limited. So it will not affect the books of Q Limited in any manner. So don't get confused that if 36 went from P, it must come in Q. ऐसा नहीं है. 36 will be paid to the shareholders of Q. So therefore, it won't come anywhere in the books of Q Limited. Okay. So once this is done, in our consolidation process, we are having investments appearing only at 5. Why 5? Why not 41? Because 36 relates to investment in a subsidiary, which we are eliminating in working note number 2, that is cost of control account. Sir, what do you mean by eliminating? Are we eliminating it in the standalone? No, standalone mein 41 hi rahega. But when you are consolidating, 36,000 relates to a subsidiary. Now, when you are consolidating, I have invested in equity shares of a subsidiary. So naturally, it has to go away because in its place, I will be replacing the assets and liabilities of the subsidiary, the profits of the subsidiary. And also I will be adjusting the equity capital of the subsidiary against that. So that is why we take only the investments outside and we eliminate the investment in the subsidiary. Cash, I told you why it is already 2,000. Okay, so I hope that it is clear. So now coming to the next part. NCI is at fair value, 300 lakhs into 55. So now we are all set to just balance the accounts. So total up your NCI. This is 16,500. 16,500. So you will be left with a 1,500 balancing figure. You will be left with a balancing figure of 1,500. Make it a habit to circle your balancing figures. Okay. So buy goodwill. What is this goodwill? This is the goodwill which is attributable to the NCI. This is the goodwill which is attributable to NCI. Remember in step number 5, we had discussed goodwill attributable to the parent and goodwill attributable to the NCI. ये वही goodwill है. This is that goodwill only. Okay. Balance this. We are left with 36,000. So this is 1,000 by goodwill. Goodwill attributable to the parent. Goodwill attributable to the parent. I'll come to that 50,000, Srishti. Just give me some time. Okay, give me some time. That 50,000 net assets, we will come to that. Don't worry. Okay, by goodwill 1,000. Okay. All right. So what is your total goodwill? You can write below NCI. Therefore, full goodwill is equal to goodwill from the COC account plus goodwill attributable to the NCI from the NCI account. 1,000 coming from working note 2, 1,500 from working note 3. So this is 2,500 full goodwill. That's right. 2,500 full goodwill. And I take this straight away to the balance sheet. I take this straight away to the balance sheet. So come to your balance sheet. Working note 3. Goodwill is appearing at 2,500. Goodwill is appearing at 2,500. Okay. All done. So working note 2, working note 3 done. Working note 4, all my profits are pre-acquisition profits. So therefore, nothing is post. So add post-acquisition profits, nothing. So this is 1 lakh. It is 0 because we are preparing the balance sheet on the date of acquisition itself. So my general reserve is going to appear at 1 lakh and this will appear at 20,000. So 1 lakh 20. So coming to your equity and liabilities, working note, note number 2, equity of the parent continues as it is. So we had how much there? 20,000 and other equity is 1 lakh 20. One lakh 20,000. Okay. So once this is done, what are we left with? Non-controlling interest can come from working note 3. That is already done. So that is 16,500 if I am not wrong. That is 16,500. 16,500 if I am not wrong. Okay, so this is done. So now we are left with only these items, assets and liabilities, that is note number 1. So just there are no adjustments except one, which is your intercompany loans. Intercompany loans. Somewhere they have mentioned entire long-term borrowings of Q is from P Limited. Okay. So where is the long-term borrowings? Long-term liabilities of Q. That means this 10,000 is entirely from P Limited. That is this 10,000. So we will have to eliminate it because they are intercompany loans and advances. Because they are intercompany loans and advances. Okay. So let us proceed to eliminate them. Let us proceed to eliminate that. 10,000 we will have to remove both from loans appearing in the assets as well as the long-term liabilities appearing in the liabilities. So 10,000 in adjustment column, and here we will be having another 10,000. Both the places it will get deducted. बस उसके बाद just go on adding. 1,51,6,000. This will become 0. 15, 15, 30, 18, 3, 30, 6, 6, 8, 4. Okay, just go on adding them. So that completes all your assets and liabilities. And now what you need to do is you just need to post it. You just need to post it in your balance sheet. That's it. So I hope you are done with this. Okay. So all of them will have note number 1 as the reference. Okay. So just go on considering them. 151, 6,000. Investments will appear at 6. Loans is 0. Inventory is appearing at 30,000. Trade receivables 18,000 and 3,000. You can total up the balance sheet later. Long-term liabilities and borrowings 30,000. Cash and cash equivalents appearing. Oh, sorry. Wrong. See, this is what happens with. Please remove this. It's already considered above. Okay, we just copied the format. Okay, just remove that. Okay. Deferred tax liabilities at 6,000. Long-term provisions at 6,000. Trade payables at 8,000. And short-term provisions at 4,000. Okay, so now just total up. Your balance sheet should at least tally. 1,51,000, 157, 187. 2,10,500 on the asset side. And 140, 170, 194, 2,10,500. Done. So any doubt so far? See that 50,000 I'll touch upon, but at least till now, anybody has any problem with the process, with the flow, with the concepts? Okay, Srishti, yes. Others, Rashmi, Nidhi Deshpande is not there today. Sumit Jain, Aniket Jain, सब कुछ समझा आपको? All clear. Okay, fine. Okay, Manini has also confirmed. All right, done. Okay, great. So now coming to some extra points. Oh, question is apparently done. Okay, so nothing else to discuss in this. Now, see, if this data was not given, if this data was not given, that is fair value of NCI was not given, then goodwill would appear at how much? Goodwill would appear only at 1000. Goodwill would appear only at 1000 and NCI would appear at 15,000. NCI would appear at 15,000. Is it okay? So this data, if this was missing, we would have to do NCI at proportionate share of net assets. So net assets would be 50,000 into 30% or these. So 50,000 into 30%, 15,000. So goodwill attributable to NCI would be 0. Only goodwill would be 1,000. So on the asset side, goodwill would go down by 2,000 by 1,500. And on the liability side, under the heading equity in NCI, that would also go down by 1,500. Remaining all items would remain the same. Your balance sheet would tally at 2,09,000. Your balance sheet would tally at 2,09,000. So that is the first case if NCI were to be at proportionate share of net assets. Okay. The next point is we are given data on the date of acquisitions. We are given the data on the date of acquisition. And since we have just now completed business combination, we can apply that concept and do the valuation of, do the calculation of goodwill based on what we have studied in step number 6. So just revisit the concept, the steps, the 6-step model. First step, identify the acquirer P Limited. Second step, date of acquisition 1st April 20x1. Third step is purchase consideration 36,000 lakhs. Fourth step is net assets. In this case is given to be 50,000. Okay. So purchase consideration is 36,000. Add NCI at fair value. I'll do at fair value first. This is 16,500. So this would make it 52,500. Fourth step, net assets. So this is given 50. Fifth step, NCI already recorded. So 2,500 would be your goodwill. 2,500 would be your goodwill. Is it okay? So you can do this 2-step mod, the 6-step model also, and arrive at the same amount of goodwill. Okay. Alternatively, if NCI is at proportionate share of net assets, I would have 36,000 plus 15,000. How did I get this 15,000? Value of net assets is 50,000 into 30%. So that gives me 51,000. 50,000 is the net assets that you have acquired. So 1,000 is your goodwill. 1,000 is your goodwill. Okay. So that takes care of that 50,000 which we had not considered. Okay. See why we did not consider that 50,000. And even then we got the right answer. Without considering that 50,000, we got the right answer. Sir, how is that possible? Very simple. See, this 50,000 is the value of net identifiable assets, which is nothing but 10,000 plus 40,000. This 50,000 is net worth. Net worth is another name for net assets. And this 50,000 is exactly what is given here to be the value of net assets. So therefore, even if we did not consider this 50,000 lakhs, we got the same answer, because what we are distributing is the net assets only between the parent as well as the NCI. So that is why we already divided that 50,000. So therefore, this 50 can be used in the business combination 6-step model. Okay, so that takes care of that. Coming to another question, sir, if both options are given in the question, fair value of net assets of the selling company and fair value of shares, which method should we follow for goodwill calculation? I think I gave you a note on this when we did business combinations. When you are given the fair value of the equity shares of the subsidiary, when you are given fair value of equity shares of the subsidiary, always perform non-controlling interest at fair value. Always perform non-controlling interest at fair value. Okay, let me check. I think I had given it to you. Ind AS 103. Special adjustments. Yes. See, I have given it to you here. You have written this also. This method can be followed only if market price or fair value of the subsidiary is given. Okay. And here I have given you. In exam, always follow this method, proportionate net assets, unless market price or fair value of the subsidiary is given. So we have already written this down. Okay. So if market price is given, please follow NCI at fair value, because that is what the institute is expecting from you. Okay. So is the first question clear? Is the first question clear? Yes. And last explanation that I have to give is elimination of intra-group borrowings. So elimination of intra-group borrowings, long-term liabilities debit to loans. From both the sides, we eliminated 10,000. Q limited and P limited. Okay. All right. Great. So that takes care of the very first concept that we had today, which is the consolidation process. Is it okay? Yes, everyone. All right. Let us then move on to the consolidation adjustments. Okay, now let us come to our discussions. Okay, just sit back, relax, understand. Okay, notes are given, everything is written there. So you focus only on understanding what is being taught right now. Okay. So now these consolidation adjustments are extremely important. Okay. Out of these, we have total about 8 to 9 adjustments. Like one is fair value adjustment, then eliminations, then goodwill impairment, then dividends, then bonus. Okay. So all these adjustments are there. So we will do these adjustments over the next couple of days. And each of these adjustments we have documented in those notes for your reference. So with these adjustments we will do, then pick up problems related to those adjustments, then come back to the adjustments, then move forward. So we'll be doing it in that approach. Okay. So first one is fair value adjustments. Fair value adjustments. See, do we start? Okay. This is your date of acquisition. Say 31st or 1st April, I'll make it. 1st April 20x1. This is your date of consolidation. 31st March 20x7. So 2, 2, 3, 3, 4, 4, 5, 5, 6, 6, 7. 6 years. Okay. 6 years have passed. You had acquired a subsidiary on 1st April X1 and you have to prepare the balance sheet as on 31st March 20 X7. So with this in mind, let us start discussing. Okay. Now see, P acquires, same problem. Okay. Same timeline, acquires 100% stake in S on 1420x1 for 5,000 rupees. For 5,000 rupees. Okay. Let's keep it fairly simple. S Limited's balance sheet on 1420x1 looks something like this. Equity share capital 1,000. Reserves 9,000. Not 1,000. 1 second. 100. 900. Land 1,000. Fair value of land is 5,000. Okay. Fair value of land is 5,000. Okay. The balance sheet on 31st March 20x7 looks something like this. Equity share capital remains at 100. P&L 2,000. Land 1,000. You earned cash. So 2,100, 1,100. 2,100. Okay. So now I have to consolidate. Now I have to do the consolidation. So if I have to do the consolidation with P Limited, okay, then the very first step is I would be preparing the balance sheet in Schedule 3 form. Okay, then I would start to take over the assets and liabilities of S Limited. Okay, first we'll understand what we will be doing. Then we will understand why it is wrong. And then we will start to understand what is the correct approach. And then we will start to understand what is the correct approach. Okay. So P Limited's balance sheet in both the cases. Okay. P Limited's balance sheet looks something like this. Okay. I'm keeping it easy. No transactions in P Limited. कितना था मेरा 5,000 ना 10,000 equity share capital 5,000 bank 5,000. Okay, so this is what was P Limited's position both on 1st April X1 date of acquisition as well as the date of consolidation. It is a purely investment entity. Okay, so it does not have any operations. Okay, this is investment, sorry, not equity capital. investment and bank. Now, step 1, prepare it in schedule 3 form. वो तो हम लोग बनाएंगे नहीं. I'll prepare it in a simple T form. So consolidated balance sheet. Okay. And then this consolidated balance sheet will be as on 31st March 20x7. Okay. The next step is assets and liabilities take over. That is the consolidation notes. Consolidation notes. So note 1 will be assets and liabilities. So in that I will have P, S, adjustment and total. So here I will be having land. P के पास तो कुछ नहीं है. Here land is appearing at 1000. Fair value अभी भी 5000 है, but we'll write it as 1000. And then I have bank. For P it is 5000. For S it is 1100. Okay. So this is note number 1. Note number 2, we start with P Limited. Uska, that is equity share capital. So this will be P Limited's 10,000. Okay. So here in consolidated equity share capital 10,000. Next one. Note number 3, consolidated other equity. Consolidated other equity. I'll be having the P&L. Standalone will be nothing because कुछ reserve था ही नहीं. Add post acquisition profits. We'll try to find out what this is. Okay. So notes 1, 2, 3 are done. Then we move on to working note 1 reserve. एक ही reserve है, so I'll not be touching much on that. Note number 2, cost of control. ठीक है. Let us proceed with the cost of control. Investment gets eliminated at 5000. Equity share capital was 100. Reserves on that date is 900. So this gives rise to a goodwill of 4000. This gives rise to a goodwill of 4000. 5000. Okay. So this is your cost of control account. All right. Working note number 3, NCI, this will be 0 because 100% stake. So 0% stake belongs to NCI. Note number 4 is your profits of the subsidiary. So the reserves are 2000. So P&L 2000. Pre was 900. Post is 1100. Entire thing belongs to the parent. Nothing goes to NCI. So this was adjusted in COC. This will be added to note number 3. So this is 1100. So now if I start pulling the figures here, I will be getting land appearing at 1000. Goodwill appearing at 4000. P&L share in the reserves appearing at 1100. Bank appearing at 6100. So this comes to 11,100. This comes to 11,100. Have you understood so far? Did you understand? Yes. This is your balance sheet. Consolidated balance sheet. Okay. I just put it in one small box. Have you guys understood? Yes. All right. So far, it appears to be correct. Okay. Any problem is there in this? Any problem is there in this? Do you see anything wrong that is happening here? I followed all the steps which we just now discussed. Okay. I followed all the steps that we just now discussed. I want you to tell me if you find anything incorrect that is happening here. Okay. So procedurally, I'm fine. Do you see any conceptual error that has happened here? Sumit Jain, Rashmi Kamath, Nidhi Deshpande, Srishti Goyal, Manini, Shailendra, Soham, Kaushiki. Do you guys see anything conceptually wrong? Yes, Sumit is right. Srishti also is right. Land is not considered at fair value. Land is not considered at fair value. See, let us do the business combination approach, the 6-step approach on the date of acquisition. So first step, identify the acquirer, it is P. Second step, date of acquisition, it is 1st April. Third step, the purchase consideration. Purchase consideration is 5,000. Fourth step, net assets acquired is 5,000. Fifth step, NCI is how much? NCI is 0. Sixth step, goodwill. Since what you have paid is what you have acquired, the goodwill should be 0. The goodwill should be 0. But here I am getting a goodwill of 4,000. I am getting a goodwill of 4,000. See, Ind AS 110 is an extension of 103. It's not a replacement of 103. So 103 date of acquisition pay, whatever happens, we keep that and then we extend the reporting in Ind AS 110. So 110 is not replacing 103, it is just bringing it forward. So therefore, conceptually speaking, I cannot have any goodwill. But now I am having a goodwill of 4,000 here. Why is that? As all of you have rightly guessed, this is because I have not considered the fair value of the land in the consolidation. I have not considered the fair value of the land in the consolidation. So therefore, how do I do it? How do I do it? See, यहाँ पे आपको easily समझ रहा है because you are given the balance sheet on this date also, on this date also. So that is why we are able to understand clearly. But in your questions, this balance sheet is not going to be given to you. What you will be given is the balance sheet here plus the reserves on this date plus certain adjustments, So here they will tell you that land is at 1,000 with fair value of 5,000, So you will have to take the movement in land of 4,000. You will have to take the movement in land of 4,000. ठीक है, so let us take that movement. So land account will increase. Land account debit 4,000. What am I going to credit? What am I going to? Can I credit bank? No, you're not buying extra land. Can I credit reserves? Yes, that is the only place I can see where you can do a credit. Okay. Now this reserve that you will be crediting, again I have a problem. What reserve will it be? Well, it could be any reserve, reval reserve, P&L, whatever it is. But more important thing is, will it be pre-acquisition reserve or will it be post acquisition reserve. What do you think? This fair value of land of 5,000, which is the value as on 1st April 20x1 when you have actually acquired, will this movement in value of 4,000 be credited to the pre-acquisition reserve, or will it be credited to the post-acquisition reserve? Will it be credited to the pre or the post? Srishti is saying pre. Obviously, this is the value on the date of acquisition. On the date of acquisition. On the date of acquisition means the movement in fair value has happened right up to the date of acquisition. That means this is my pre-acquisition period. This is my pre-acquisition period. Okay. Whereas this is going to be my post-acquisition period. The movement in fair value, is reflected on the date of acquisition. जब adjustment देंगे, they will tell you the fair value of land was 5,000 on the date of acquisition. Okay. The fair value of the book value of land was 1,000 and the fair value was 5,000 on the date of acquisition. Matlab, up to the date of acquisition, the fair value has increased by 4,000. That is why it becomes a pre-acquisition increase. It becomes a pre-acquisition increase. So I will be crediting the pre-reserves to pre. The question is, which reserve should I credit? Should I credit revaluation reserve? Should I credit P&L? Which reserve should I credit? It does not really make a difference. Okay. You can credit your pre-P&L. You can credit your pre-revaluation reserve. You can credit any reserve that you want. But academically speaking, we will be crediting it to pre-P&L. We will be crediting it to pre-P&L or pre-retained earnings. Sir, why in Ind AS 16 for upward revaluation, we would credit it to reval reserve? Agreed. But usse kya ho raha hai na? The reason is pretty straightforward. If you create a new reserve and credit, uske liye you will have to do another working note. For that, you will have to do another working note. Analysis of revaluation reserve. And then it would go and sit in your pre-acquisition profits. Add 4,000. Instead of making another working note, if I do this adjustment in the P&L only, ultimately it is a pre-acquisition impact. Ultimately, it is a pre-acquisition impact. Since it is a pre-acquisition impact, वो P&L में जाए या revaluation में जाए, ultimately the acquisition impact will go to the cost of control account. Finally, from there, it will be affecting my goodwill or capital reserve. That's it. बाकी ये reserve कहीं पे भी आएगा नहीं in the balance sheet. This reserve is not going to come in any form in the consolidated balance sheet, and therefore we will prefer to do the adjustment in the pre-P&L only in the interest of saving time. Only in the interest of saving time. However, I'm telling you, there is nothing wrong if you take it to the revaluation reserve also. That is also right. But only for saving your time, we are taking it in the pre-P&L so that one more analysis of reserves need not be conducted. Okay. So let us take it to pre-P&L 4,000. So now let us start to understand how my analysis is going to look like. So pre-acquisition reserve is appearing at 900. To this, you will add fair value adjustment 4,000. So this is now 4,900. 1,100. Okay. This 4,900 goes to COC account. So I have prepared my COC account here. So yahan pe my pre-reserves will be 4,900, resulting in a zero goodwill. Okay, resulting in a zero goodwill because the account tallies. Okay. So now when I prepare the balance sheet, goodwill will not appear. but land is going to appear at, this is upward valuation of 4,000. So this will go in adjustment column 4,000. So this will become 5,000. So land appears at 5,000. Goodwill kuch nahi rahega. So this is how your balance sheet will now look like. Goodwill will vanish and land's value will increase by 4,000. Is it okay? Have you understood? Have you understood? Yes. All clear? Okay, fine. Okay, so Nidhi is there. Good. So that takes care of the first part. That takes care of the first part. All clear. Kaushiki confirmed. That takes care of the first part. Now we move on to the next part. Now we move on to the next part. Okay. I'll just modify that question a little bit. Date of acquisition 1420x1. You are preparing the balance sheet as at 31st March 20x2. And remaining all facts remain the same. Rest all facts remain the same. Okay. Only thing is, okay. So P Limited. P Limited. Equity share capital 10,000. Investment 5,000 and bank 5,000. Okay. Now S Limited. 1st April 20x1. Equity share capital. I'm keeping the same data 100. Reserves 900. Only thing what I'm changing is, instead of land, this is a building. This is a building with a value of 1,000. With a value of 1,000. Okay. So now fair value of this is 5,000. Fair value of this is 5,000. Okay. And then useful life is 10 years. Useful life is 10 years. See, land was a non-depreciable asset. तो उसका काम तो खत्म हो गया. So there is no problem here. There is no problem here. Now let us move to doing the adjustments. I have kept the figures the same. I have not changed anything. Okay. S Limited 1st April 20x2. Okay. All right. Equity share capital 100. Building 1,000 minus 100, so that becomes 900. This is 1,000 minus 100 on account of depreciation. So this is appearing at 900. P&L. I'm keeping the same facts. 900 plus 1,100 plus 1,100 minus depreciation of 100. So that gives you how much? That gives you 1,900. And then you will have bank balance. Bank balance 1,100. It's exactly the same. Okay. 2,000 2,000. So this is how the balance sheet is as at 31st March 20x2. 31st March 20x2. Okay. So with this, let us now do the consolidation quickly. Okay. So first thing is prepare the balance sheet. Okay. I'll prepare the balance sheet. Ye raha consolidated balance sheet. And now when I have the consolidated balance sheet, let us then proceed further. Let us then proceed further. The next one is note number 1. That is assets and liabilities. So PS adjustment total. So here I will be having bank balance and here I will be having land. So P's bank is 5,000. S's bank is 1,000. The land of S on the date of acquisition as well as the date of consolidation also is appearing at 900. Sorry. This is appearing at 900. Okay. This has no other asset. Okay. So this is done. Then note number 2, equity share capital of the parent only will come. So that will be P Limited, equity share capital 10,000. Then note number 3 will be consolidated other equity. So note 3, consolidated equity, other equity. Okay. All right. Then working note 1 equity ka hi aayega. Here I'll just pull up standalone P. Kitna hai? Nothing. Okay. Add whatever comes from S. Okay. So note 3 is done. Working note 1 is done. We then move on to working note 2. That is COC account. COC account. So here I will be eliminating the investment. Note number 3, working note 3 will not come because there is no NCI. Okay, sorry, this is building. Stupid mistakes from my side. Building. Okay, all right. So COC account will be there. I will write here investment. How much is that? 5,000. Okay, so COC account is done. NCI will not come. Then we proceed to analysis of reserves. Analysis of P&L. Working note 4. Okay. What is the balance in your P&L? Sir, that is 1,900. Okay. So 1,900. So we do the split pre-post. So on the date of acquisition, it was actually 900. Then it became 1,000. Okay. You have earned 1,000 thereafter. So here there is an upward increase in fair value. There is an upward increase. Building of 1,000 is actually worth 5,000. So fine. So we will do a fair value adjustment. हमने अभी पढ़ा है. So we will do a fair value adjustment. So 4,900. This will be 1,000 only. Okay. So now what will be the impact? Well, this impact is 4,000 is going to come and get added to building. Okay. So now your building will appear at 4,900. This will appear at 5 plus 1, 6,100. Okay. If I put my COC account, equity share capital of the subsidiary worth 100. Pre-reserves or pre-P&L 4,900. 5,000, 5,000, no goodwill. Add post-acquisition profits. Post S Limited. Post acquisition profits of S 1000. 1000. So reserves or other equity, what you call, this is going to be 1000. Then I will be having building appearing at 4900 and bank balances at 6100. So this is 11,000. This is 11,000. Okay. And this is your consolidated balance sheet. Okay. So now, is this clear so far? Is this clear so far? Is this clear? Have you understood? Yes. Any issue? The next question is, any issue? Is there any issue with this balance sheet, or do you think that it is correct? Do you think that it is correct? Okay. Give me your answers. Kaushiki, Nidhi, क्या लगता है आपको? Is this balance sheet correct? Is it incorrect? If incorrect, what is the mistake? I'm not asking for effect. I am asking for the mistake. Okay. I'm getting 2-3 answers. Okay. All right. Fine. Fine. Manini is giving the answer. Rashmi has given. Srishti has given. Come on, guys. Think. Sumit Jain. Okay. All right. Others. Okay. See, if this consolidated balance sheet is presented to the readers, presented to you, what are you going to look at? Well, you will look at the building. Building is worth 4,900. Okay. Then you are a person who knows how to read financial statements. So in this consolidated financial statements, you will be having gross block 5,000, depreciation 100, net block 4,900. And then you will look at the consolidation policies. You will look at the accounting policies. In accounting policies, you will have a policy relating to property, plant and equipment. In property, plant and equipment, क्या लिखा रहेगा? Depreciation is measured based on the useful lives of the fixed assets. In the case of building, we have estimated the useful life to be 10 years. आप ये लिखोगे. Now you are a person who understands financial reporting. You are a person who knows what is the meaning of useful life. You are a person who knows what is the meaning of useful life. You know what is the meaning of depreciation. You know how to calculate it. So immediately you will look at the balance sheet. 5,000 is your cost or revalued amount. And if 10 years were to be my useful life, yeah, in that case, my depreciation should be at least 500. Hai ki nahi? But my depreciation is actually only 100. My depreciation is actually only 100. Yes. So now the question, now you will be the reader who is now a confused reader, because now he's saying, yeah, one side you are saying 10 years useful life. The other side you are saying that it is only 100. That means you are attributing how much? I think you will be attributing 5,000, if that is your value and depreciation is 100, then that means you are probably giving a 50-year useful life, whereas accounting policies you say it is only 10 years. Yaar kuch to gadbad hai. So this is the confusion that will be created in the minds of the reader of financial statements, because we are not revising the depreciation. See, the moment you increase the fair value, as a corollary adjustment or as a subsequent related adjustment, the depreciation on such increased value also should be provided for. Yes or no? अरे भाई आपका वैल्यू 1000 था, 1000 के लिए 100 का डेप्रिसिएशन करेक्ट है, बट नाउ 1000 का 5000 हो गया, द वैल्यू मूव फ्रॉम 1000 to 5000, तो डेप्रिसिएशन सेम कैसे हो सकता है? द डेप्रिसिएशन ऑल्सो शुड चेंज, because ultimately the value of 5000 has to be written off over the next 10 years. Ultimately, the value of 5000 has to be written off over the next 10 years, and therefore you will be having an additional depreciation that will be charged. You will be having an additional depreciation that will be charged. Is it okay? Yes. And that is why we will now proceed to calculate the additional depreciation. We will now proceed to calculate the additional depreciation. Sir, additional depreciation, see, my valuation went up by 4,000. 4,000 I have to write it off in the next 10 years. तो मेरा तो 400 का वैल्यू बैठ रहा है additional depreciation. All right. The question is, this additional depreciation, will it pertain to pre-acquisition period or will it pertain to post-acquisition period? Will it pertain to pre or will it pertain to post? The answer is, sir, you did a revaluation on the date of acquisition. That is right. Additional depreciation तो उसके बाद होगा ना. Additional depreciation will happen after 1st April X1. Array, when you are preparing the balance sheet on 31st March 20X2, is it a post-acquisition balance sheet or a pre-acquisition? Sir, it is a post-acquisition balance sheet. So ये जो movement है on account of depreciation, is it going to happen prior or is it going to happen after acquisition? Sir, it is happening after acquisition. So therefore, the increase in fair value on the date of acquisition was regarded as pre, because the fair value had increased in the pre-acquisition period up to the date of acquisition. Thereafter, the write-off which is going to happen in the form of additional depreciation, that write-off will be in the form of post-acquisition depreciation, would be in the form of post-acquisition depreciation. Is it okay? समझ में आ गया? Yes. Those of you who mentioned pre, are you clear why we call it post? Yes. Are you clear? Those 100 rupees depreciation is already charged. देखो, the total value of the building is 5,000. The total value of building is 5,000. On 5,000, the depreciation is 500. अरे, but out of 500, 100 is already charged. आप इसको दोबारा charge नहीं करोगे. You will not charge this again. What you are going to charge is only this additional 400. ये 100 तो charge हो चुका है. Here, see this 100, you can have a look. It is already charged here, minus 100 depreciation. So this 100 depreciation ka impact already is reflected when I am doing the attribution of the profits, when I'm doing the allocation of the profits. Is it okay? Did you understand? Fair value is on the date of acquisition. Tell me, if there is a fair value increase on date of acquisition, When was the asset acquired? Sir, asset तो पहले लिया होगा ना. Since it is appearing on the date of acquisition, asset would be acquired before that. So suddenly earnings के वजह से तो acquisition के वजह से तो fair value cannot increase ना. Fair value increases because over a period of time. Fair value of an asset increases over a period of time. Is it okay? So therefore, this increase happens here and it is reflected on the date of acquisition. Sir, why Ind AS 103 yaad karo? The net assets have to be stated at fair value. So I do a fair valuation exercise on 1st April 20x1. But that doesn't mean that fair value increase which I am recording on 1st April x1 has actually happened on 1st April x1. The fair value has increased over the past periods, and that increasing effect we are giving it on the date of acquisition. On the date of acquisition. Is it okay? Why it cannot be post? Yes, all right. All right. Shailendra, आपका question समझा नहीं. Why take first example, take pre? समझा नहीं मुझे. आप जरा बता पाओगे तो अच्छा रहेगा. Okay, all right. Now let us move on to the next. So therefore, all the movements in fair value on the date of acquisition is actually a pre-movement. Because acquisition के वजह से your assets will not become valuable. It is because of the change in characteristics of the assets up to the date of acquisition that you are having a fair valuation exercise. You are having a fair valuation exercise. Okay, so that will give rise to an additional depreciation in the post acquisition period. That will give rise to an additional depreciation in the post acquisition period. That additional depreciation is worth how much? That additional depreciation is worth 400. That additional depreciation is worth 400. So here you will have fair value adjustment depreciation. 1000 will become 600. 1000 will become 600. This 600 we will be adding it here. So my consolidated other equity will become 600. And what about building? Well, building का value भी कम होगा. Building का value भी कम होगा. Sorry, ये तो bank हो गया ना. Why am I recording it here? 600. And then building will be 4000 minus 400. So this will fall to 4500. 4500. All right. So with this, am I getting a tallied balance sheet? Yes, I am getting. The balance sheet tallies at 10,600. Is it okay? Yes. In the earlier example also, see, land movement is taken in pre-acquisition profits. 100,000 से 5,000 का movement is taken in pre. Baba, the same movement, 1000 ka 5000 is also taken in pre only. I am keeping the same example, same case. कोई change नहीं है. देखो, पहले केस में land increased from 1000 to 5000 on the date of acquisition. So that impact मैंने कहाँ लिया था? मैंने वो impact प्री एक्विजिशन में लिया था. The same thing, I have only changed the asset. लैंड के बदले में मैंने बिल्डिंग डाल दिया. So therefore, on the date of acquisition, building was worth 1000, but fair value is worth 5000. तो देखिए, pre-acquisition reserve was worth 900. I increased it by 4000. क्यों? It is nothing but this fair valuation movement from 1000 to 5000. So therefore, 4900 is my pre-acquisition reserve. Is my pre-acquisition reserve. मैंने 4000 का movement पहले भी pre में लिया था. Now also I am taking it in the pre-acquisition reserve only. There is no change in that. What is changing is, in the earlier case, it was land. Land is a non-depreciable asset, तो आगे जाके कोई adjustment नहीं होगा. But in the case of building, it is a depreciable asset. So I have to depreciate the building over the next 10 years. Therefore, this 4000, I will have to write it off by way of depreciation. I will have to write it off by way of depreciation. So each year, apart from 100, देखो ये 100 is already written off. So apart from 100, मैं extra 400 rupees every year I will write it off against post-acquisition profits. Against post-acquisition profits. Why post? Because now the depreciation is charged after P has acquired control. After P has acquired control over S. And that is why depreciation is going to be charged. On the date of acquisition, increase in value, P did not have any control. And that is why we are taking it as pre-acquisition. Thereafter, I have to write it off because accounting requires me to write off the value of the asset over the remaining useful life. So the value of the asset is the increased value after the fair value adjustment. So there is going to be an increased depreciation on account of the fair value adjustment. That increased depreciation is going to happen after the date of acquisition. And that is why that additional 400 rupiah is going to be depreciated as additional depreciation in the post-acquisition period. Shailendra, is it clear? पक्का 100% clear हो गया आपको? Just बता दो. Okay? Just let me know. Okay? All right. Sir, even if we are consolidating after many years, then also do we have to take the fair value as on the date of acquisition? Isn't it misleading? Okay. Good one. See, understand one thing. When we talk about fair value adjustments, this fair value adjustment is not in pursuance of Ind AS 113 that deals with fair value measurement. This is a fair value adjustment in relation to acquisition that has given rise to goodwill on the date of acquisition. Now that goodwill which you have calculated, I told you, the whole purpose, the whole crux of 103 lies in the fact that you will have to ensure that that goodwill remains sacrosanct. That goodwill remains sacrosanct. Okay. तो उस goodwill को हम हाथ नहीं लगा सकते. We cannot touch that goodwill in the future. So the reporting will be based on that fair value. अच्छा, can I have a fair value movement after the date of acquisition? Definitely. Who will stop you? Nobody will stop you. So if there is a fair value movement, suppose now building up on Soham's question, what Soham is trying to tell is fair value on this date, fair value of land on this date is 5,000. Suppose in the 4th year, okay, that is on 31st March 20x 2, 3, 1, 2, 2, 3, 3, 4, 4, 5. On 31st March 20x5, the fair value of this land is, let us suppose, 7,500. So what Soham is trying to ask is, sir, can I always keep the fair value at 5,000 and should I never restate it to 7,500? That choice belongs to you. As a parent entity, that choice belongs to you. See, it's not mandatory to do a fair valuation exercise on every reporting date. It depends on the accounting policies that you are following. Once you do the fair valuation on the date of acquisition, you meet the requirements of 103. Then you look at Ind AS 113. Ind AS 113 tells you can do a fair valuation. It's not mandating you to do the fair valuation. It is saying, अगर आप fair value करना चाहते हो, तो बेशक करो. Then you use the principles of 113 for determining the fair value. For subsequent fair value measurements, you will have to look at the policy guidance given in Ind AS 16 on property, plant and equipment, which tells you that you are having two options. You can follow historical cost model or you can follow the revaluation model. This revaluation model will require a regular revaluation whenever there is a change in the fair value of the asset that is existing with you. However, is it mandatory to revalue? Again, I repeat, answer is no. Sir, why you revalued on the date of acquisition? That is not as per Ind AS 16. That is as per Ind AS 103. They are two totally different approaches. Ind AS 16 revaluation is optional. Okay, it's an accounting policy choice. Once you choose to revalue, do the revaluation at reasonable intervals. But 103 fair valuation is mandatory. You will have to do it. Acha, suppose I have a revaluation model in place. How do I do the accounting for this 5,000 to 7,500? You will only give me the answer. This movement from 5,000 to 7,500 has happened after the date of acquisition. And because it has happened after the date of acquisition, this 2,500 will be a movement in the post acquisition period, and therefore इसका impact कहां पर आएगा? इसका impact यहां पर आएगा, add fair value adjustment 2,500. But I repeat again, this 2,500 is a fair valuation adjustment pursuant to Ind AS 16. This is not pursuant to 103, neither is it pursuant to 110. No problem. You can follow the fair valuation concept later on. Only thing is, it will be impacting the post-acquisition reserves, not the pre-acquisition. Pre-acquisition का जो 4,000 था, it will remain at 4,000 only. Building के case में same thing. So suppose you have 5,000 to 7,500. How do you do in Ind AS 16? Calculate the WDV as on 31st March 20x5, look at the fair value, increase it, and then do the accounting, and the increased value you depreciate over the remaining life up to the date of consolidation. So that's how the accounting will happen. Under no circumstances will I ever change the fair value on the date of acquisition. एक बार एक्विजिशन हो गया, उसके बाद उसको हाथ नहीं लगाने का. वो गुडविल जो आया है, that goodwill is all going to be your permanently appearing asset. Only two cases it will change. One case is measurement period. The other case is what we will be discussing by way of the second adjustment today. By way of the second adjustment today. Okay. So with that, this is done. Okay. हमें एक और क्वेश्चन आया था, सर फेयर वैल्यू कम भी हो सकता है? बेशक, डेफिनेटली इट विल बी लोअर, नो प्रॉब्लम. सो सपोज 1,000 का बिल्डिंग इज वर्थ 800. Suppose this fair value falls to 800 on the date of acquisition. तब क्या करेंगे? What will we do? Well, first thing is fair value adjustment will have a negative of 200. Because fair value adjustment will have a negative of 200, in the future years, I will be having a depreciation saving of 20. I will be having a depreciation savings of 20. So on the date of acquisition, if there is a fall in the value of asset, the entry will be pre-acquisition reserves account debit to property, plant and equipment. Value has come down. Uske baad, there should be a proportionate saving in depreciation over the remaining useful life. So that is what we will be recording in the post-acquisition period. That is what we record in the post-acquisition period. Is it okay? एवरीबडी सुमित आपका क्वेश्चन था ना ये 1000 से कम होगा तो क्या होगा 1000 से कम होगा तो हम लोग वो वैल्यू रिकॉर्ड करेंगे एंड देन जो डेप्रिसिएशन का सेविंग होगा वो डेप्रिसिएशन का सेविंग पोस्ट एक्विजिशन पीरियड में होगा सो दैट पोस्ट एक्विजिशन पीरियड विल बी रिकॉर्डेड सर टैक्स इफेक्ट इज टू बी इग्नोर्ड definitely not tax effect has to be considered but I will not cover tax effect right now क्योंकि आपका deferred tax is not yet done, so we will not be touching tax effects right now. Okay, it will start getting too complicated if we start introducing tax impacts. You need to know what is the meaning of tax base, carrying amount, and then the difference, whether it is a taxable difference or a deductible difference. All that is what is going to be done. Okay, yes, the valuing at fair value on date of acquisition is irrespective of valuation model adopted as per Ind AS 16. Absolutely right, because on the date of acquisition the fair valuation is done basis Ind AS 103. Remember Ind AS 103 step number 4, it is net assets at fair value. All assets will be appearing at fair value. Even those assets which do not appear in the balance sheet will be recorded. Okay, even those assets which do not appear in the balance sheet will start getting recorded in accordance with Ind AS 103. We took the contingent liabilities as a liability in the Ind AS 103 chapter. Why? Because I want to actually find out how costly my acquisition was, which is determined by the value of goodwill, which is determined by the value of goodwill. Okay, all right. So that takes care of fair value adjustment in relation to fixed assets or in relation to property, plant and equipment. Is it okay? Yes. All right. Now let us move on to the next fair value concept only, but we now move on to the other concept, that is fair value adjustments relating to inventory. Relating to inventory. Okay, sir, you took first a non-depreciable asset, you took a depreciable asset. Do we have fair valuation only of PPE? No. Ind AS 103 requires fair valuation of every asset, every liability. So now we look at the fair value adjustments relating to inventory. Am I audible now? Check. Hello. Am I audible now? Are you able to hear me? Yes. All right. Fine. So now suppose we stick to the same concept. Date of acquisition is 1st April 20x1 and 100p acquires 100% stake in S for rupees 5,000. For rupees 5,000. Okay, same concept. Only thing is we will replace it with inventory. That's it. So S Limited's balance sheet on 1st April 20x1 looks like this. Equity share capital 1,000, P&L 3,000, inventory 4,000. 4,000, 4,000. Do I have to fair value inventory? Yes, this is as per Ind AS 103. Don't ever make the mistake. Fair value is 5,000. Don't ever think, sir, inventory should be at lower of cost or NRV. So therefore we will measure it at 4,000 because fair value is higher. Don't make that mistake. This is, I repeat, fair value as per Ind AS 103, which is quite different from the NRV testing which we do under Ind AS 2. तो अगर इन्वेंट्री का वैल्यू बढ़ा है, if there is an increase in the value of inventory, then you will record that increased inventory in the step number 4, net assets at fair value. See, Ind AS never talks about being conservative. I told you before, I'm telling you now also, Ind AS wants you to be realistic. Acquisition हो रहा है. You want to find out what you have actually acquired. भाई worth क्या है उसका? Suppose as on today you have acquired okay, so let us take an example. Tanishq acquires PNG Jewelers. I think you would have heard the names of both of them. Okay. Tanishq acquires PNG Jewelers. Now, PNG Jewelers on the date of acquisition, let us assume it is having 5,000 kgs of gold. It is having 5,000 kgs of gold. This gold was accumulated over the years with PNG. This gold was accumulated over the years with PNG. जायज़ सी बात है, the cost of this gold would obviously be different at different points of time. The cost of this gold, for some it would be 40,000 for 10 grams. In some cases it would be 45,000, 50,000, 30,000. These are all legacy gold which PNG is having. Now, when Tanishq acquires PNG Jewelers, PNG will say the value of my gold is say 55,000 per 10 grams on the date of acquisition. Tanishq cannot say you follow cost or NRV, whichever is less, because gold is your inventory. No, PNG will say you are acquiring my business. I have to give the gold to you at the fair value on the date of acquisition. And that is why, even though the cost is say 4,500 per gram, the acquisition will happen with a fair value of 5,500 per gram only. Okay, so don't get confused that value of inventory is gone up. It will. If the fair value is higher, it will be recorded at a higher fair value. Okay. So anyways, this was for your understanding. Okay. So now moving to the next one. Suppose you don't adjust the inventory. Suppose you don't adjust the inventory, don't do anything. First step, consolidated balance sheet. Second step, record the assets. Note 1, PS adjustments total. Here I will be having inventory. S is 4,000. Don't do any adjustment. 4,000. Note number 2, equity share capital, that will be of the parent, obviously. So P Limited. What I'll do is I'll skip the consolidated balance sheet, because now you know consolidated balance sheet. I'll just discuss the cost of control account. That is more important. Ultimately, the remaining are all procedurals. So cost of control account, investment will be eliminated, 5,000. Okay. That is done. Then no NCI because my stake is 100%. Then I will look at my P&L. 3,000 entirely it is pre. So therefore, I will pull this 3,000 here. Okay. So equity share capital of the subsidiary 1,000, P&L 3,000. So you are going to end up with a goodwill of 1,000. You are going to end up with a goodwill of 1,000. Tell me now, is this correct? Is this correct? Is this correct? What do you guys think? Is it correct to show the goodwill of 1,000? Is it correct to show the goodwill of 1,000? Or is it wrong? No. Obviously, no. Same concept applies. What we will be doing is we will be adding fair value adjustment. There is an increase in value of 1,000. So add 1,000. So your pre-P&L is worth actually 4,000. So this is going to be 4,000. Goodwill will be 0. Inventory that you will be recording in the consolidated balance sheet will be at 5,000. Inventory that will be recorded will be at 5,000. Is it okay? So now I think that you would be fairly convinced about this fact. You would now be fairly convinced with this. Okay. Done. Are you clear up to this? Yes. अभी तक समझा अपने को? Yes. All right. Now we move on to 20x1x2. This is not property, plant and equipment. This not convinced. Okay. What are you not convinced about? See, same concept like how we had for property, plant and equipment. Okay. See, earlier P&L was 3,000. So your goodwill was coming at 1,000. Okay. So this was what is your position. This was what is your, I'm coming to that. I'm coming to that. I have still not yet done. So if you're convinced about no goodwill, then I will move on to the next adjustment. Then I will move on to the next adjustment. Okay. If you are convinced about this, अभी तक तो मैं बाद की बात किया ही नहीं हूं. I have not yet come to what will happen in the future. I am still stuck on the date of acquisition. Now I am moving forward to the post acquisition period. Now I am moving forward to the post acquisition period. Okay. Now ये inventory है. So one thing is sure, this is not going to get depreciated. This is not going to get depreciated. Sir, then what happens with inventory? Sir, inventory is going to get sold in the future. This inventory is going to get sold in the future. Okay. So now P&L of S Limited for 20x1 x2. P&L of S Limited for 20X1, X2, keeping it very simple. The same stock of 4,000 is brought forward as opening stock. This stock is sold for 5,500. So therefore, it is having a net profit of 1,500. I am keeping it very simple. Forget other expenses, forget everything. So in your post-acquisition profit, in the post-acquisition period, S Limited has made a net profit of 1,500. So this is done. So if I have to draw S Limited's balance sheet as on 31st March 20X2, if I have to draw S Limited's balance sheet as on 31st March 20X2, it will look something like this. Equity share capital 1,000. From here, P&L 3,000 plus 1,500. P&L 4,500. Inventory to chala gaya. In its place, you will have cash of 5,500, which is basically the sales. 5,500. Are you convinced with these two items? Yes. Each one of you, are you convinced with this? Yes. Are you convinced with this? I have not done any consolidation adjustment. Right now, I have only taken the transaction after the date of acquisition in S Limited's balance sheet. तो अभी तक कहानी चल रहा है. It is going on in a very smooth manner. Now, 31st March 20X2 has come, the time for preparing consolidated financial statements. And when I have to prepare the consolidated financial statements, note, I'll start with the balance sheet. After the balance sheet, I will have note number 1. Note number 1, I will have PS adjustment total. Here, inventory was there and now cash is there. Inventory was there and now cash is there. Now just pay attention. Now just pay attention. It is going to look something like this. 31st March को P के पास तो कोई इन्वेंट्री नहीं था. S के पास इन्वेंट्री था 4,000. There was an inventory of 4,000, but that inventory is no longer there because that inventory got sold. But at the same time, this adjustment entry has not yet vanished anywhere. Ye adjustment entry is happening in consolidated books. So in consolidated books, this 1,000 is still there. I know it sounds illogical. How can I have adjustment entry without the asset in place? But वैसा ही है, because this 4,000 is the value from the standalone financials. Whereas this is your consolidation adjustment. Standalone में this asset vanished away. So consolidation में I still have to give an effect for this. So this 1,000 remains as it is. And now S Limited is coming to you with a 5,500 cash. Okay, with a 5,500 cash balance. So this is the position of note number 1 as it looks right now on 31st March X2. NCI will not be there. We move on to working note 4, that is analysis of profits. Analysis of profits. And when I have to analyze the profits, profits are 4,500. Sir, kaise? Ye hai na? 4,500, out of which 3,000 is pre-acquisition, 1,500 is post-acquisition. I'm taking you step by step. Later on, you can ask your questions. Okay. I'll just need you to answer yes or no whenever I ask. Okay. So on the date of acquisition, this was worth 3,000. 1,500 is earned post acquisition. So this will be added to reserves. This will be added to reserves. Okay. So therefore, if I talk about note number 3, consolidated P&L, standalone of the parent, whatever be that figure, add post acquisition profits 1,500. Okay. Okay. This is how it looks like. Just tell me procedure wise, concept bhul jao. Don't tell me about concepts right now. Procedurally, are you convinced that this is correct? Don't talk about concept. I will ask you about concepts. Procedurally, what we did since today morning, are you guys convinced? Procedurally, I have not deviated from any of the processes. I did note 1, took the assets and liabilities as it is. Adjustment column I could not eliminate because I have not passed any consolidation eliminations for that 1,000. Profits are analyzed pre-acquisition, on the date of acquisition, post-acquisition, thereafter. Post-acquisition is taken to the reserves, that is the consolidated profit and loss, and I have added it there. So procedural, this is correct. Yes. Now I want you to tell me conceptually what is wrong. Now I want you to tell me conceptually गलत क्या है इसमें? What is incorrect here? What is incorrect here? क्या गड़बड़ दिख रहा है? All of you are saying procedure wise it is fine. Good. Conceptually you are still not convinced. So conceptually I want you to tell me कि भाई गलत क्या है? What is wrong conceptually? Adjustment of 1,000. Adjustment of 1,000. If I have to prepare a consolidated P&L, if I have to prepare a consolidated P&L, the opening stock will not appear at 4,000. क्या था वो यार? The opening stock will not appear at 4,000. The opening stock in the consolidated P&L will actually appear at 5,000. The sale will actually happen at 5,500. In that there is no change. So your net profit will actually be 5,500 for the purposes of consolidation. The actual impact on consolidation is you will have a net profit of 500. You will have a net profit of 500. Sir, क्यों 500? Because on the date of acquisition, you have already recorded the increase in fair value in the inventory. You have already booked. Is it correct? It's absolutely correct because that increase in fair value is in line with Ind AS 103. तो ये जो 5,000 है ये गलत नहीं है. This is not wrong. ये जो net profit है ये भी गलत नहीं है. This 500 also is correct. What is wrong is you have directly added this 1,500 to the inventory when in fact you need to do the adjustment of 1,000. When in fact you need to do the adjustment of 1,000. So ultimately, now please listen to my words. This consolidated P&L pertains to the post-acquisition period. That is right. Since it pertains to the post-acquisition period, it is impacting my post-acquisition profit. Absolutely right. Since it is impacting my post-acquisition profit, What will be the adjusting entry that will be passed? Sir, the post acquisition profit was 1,500 of the subsidiary. But in true sense, the post acquisition profit should be 500. And therefore, profit is going down. So debit the post P&L. Debit the post profit and loss account with 1,000. Debit the post P&L with 1,000. And what am I going to credit? Sir, you are ultimately going to credit that inventory whose value you have increased by 1,000. Whose value you have increased by 1,000. Ultimately that inventory only is going, no? तो ये वही inventory का adjustment है जिसका impact हम लोग अभी ले रहे हैं. This is that very impact which we are taking it now on account of fair value adjustment. Okay, so when I pass this, the P&L of S, which was appearing at 4,500, will now be split like this. Pre-acquisition, post-acquisition. This was 3,000, I agree. This is 1,500, I agree. There is a positive fair value adjustment of 1,000. This positive fair value adjustment gets reversed in the post-acquisition period and it falls to 500. It falls to 500. And since this 1,000 gets adjusted in the post-acquisition period, I will deduct 1,000 from inventory. So inventory mein the impact is going to be 0. The impact is going to be 0. Did you understand? Yes. Have you guys understood correctly the impact of fair value movement on inventory? Yes. Everything is there in writing. So don't worry, how am I going to remember it? How am I going to understand? Everything is there in writing. So you don't have to worry at all. Okay. So you don't have to worry at all. Are you now clear with what has happened in the post acquisition period? Everyone? Okay, please explain again. Good. You need a 5-minute break so that you can just refresh yourselves, or can I proceed? You guys need a break? I know it is a little confusing. What we will do is we'll take a 5-minute break, exactly 5 minutes. It's 9:13. We meet at 9:18. We take a break, then we try to understand. And once it is done, I think you should be able to follow. Okay, so a 5-minute break, quick break, because once I finish this, then I will take you through the last one, that is payables. And once that is done, we are done for today's class. Okay, so we meet after 5 minutes. Nisar? Okay. All right. Okay, guys. So let us come back to the fair value adjustment relating to inventory. See, you understand the entry, the concept you understand. The fair value adjustment impacts is very simple. Once you see the theory summary that we have written, all the impacts are very, very simple. So you will not have any problem in understanding. So right now, don't get yourselves worried ki bhai exam mein what are we going to do? Okay. In exam, the impacts that you will have to give, it's actually very simple. Okay. So when we go through the theory in a couple of minutes from now, you will understand. Okay. So now coming back to our inventory case. Okay. P acquires 100% stake in S for 5,000. This is clear. So on that date, S Limited's balance sheet had equity capital, P&L and inventory of 4,000. The fair value of that inventory is 5,000. So ideally, if I have to follow the business combination approach, the entry would be net assets debit 5,000 to bank 5,000. There won't be any goodwill or capital reserve. There won't be any goodwill or capital reserve. Okay. So therefore, the same impact should follow in Ind AS 110 also. That is the cost of control. So therefore, what do we do is, I will have to do a fair valuation of this inventory on 31st March 20X2 when I'm actually consolidating. Now, for the purpose of consolidation, let us understand what I'm going to do. This is an item of inventory. So inventory is not depreciated. Inventory gets sold. Sale gives rise to profits. So therefore, post acquisition period X1, X2, the profit and loss of S Limited look something like this. The opening stock of 4,000 is sold for 5,500 with a net profit of 1,500. See, just because the net assets are fair valued on the date of acquisition for the purpose of business combination doesn't mean that the subsidiary also should fair value its assets. Sir, फिर से बोलो, just because in consolidation for business combination, I have to fair value assets and liabilities, it does not mean that I have to do the same in the standalone books. So S Limited need not do a fair valuation of land, need not do a revaluation of building, need not do a revaluation of inventory, because it is a standalone entity. It is an independent entity having its own set of accounting policies. But 103 mandates fair valuation at the time of consolidation. At the time of consolidation. Okay. So that time you have no choice. But again, the impact is only on business combination, not in the standalone records. So in the standalone records, S Limited is making a profit of 1,500. Which is giving rise to this statement, 1,000, 4,500 P&L and 5,500 cash balance. On the date of acquisition, your inventory gets consolidated in this manner. P has no inventory. S had an inventory of 4,000. That 4,000 has to increase by 1,000. So P&L was 3,000. That became 4,000 by virtue of fair value adjustment of 1,000. Entirely, it relates to pre-acquisition reserves. Entirely, it relates to pre-acquisition reserve. Once I do the fair valuation, you can now check and appreciate the net assets become 5,000, which is exactly equal to the takeover entry net asset value of 5,000. So that is why we do the fair valuation. The purpose behind fair valuation is to ensure that my goodwill figure goes correct, because that fair valuation is in pursuance of Ind AS 103. शौकिया fair valuation नहीं है वो. It is not a fair valuation out of what you say obsession of fair value. It is a fair valuation in pursuance of Ind AS 103. So the net assets which we are crediting to the cost of control in the form of equity capital and P&L reflect the net assets of the company on the date of acquisition. So this 1,000 rupees is an adjusting entry on account of consolidation. So this is understood. Now, once we do this, let us move to the post-acquisition impact. I'll come to the consolidated P&L first. Then I will try to reconnect with that 1,000 rupees adjustment. In consolidated P&L, you have taken over the inventory at 5,000. So inventory will be at 5,000. The sale is happening. It is sold for 5,500. So for consolidation purposes, your net profit should be 500. S Limited's profit kitna tha? Sir, it was 1,500. When did this profit arise? Before acquisition, after acquisition? Sir, this arose after acquisition. So can I say that this is my post P&L? Yes, it is your post P&L. Whereas for the purposes of consolidation, your net profit should actually be 500. Yes. Why 500? Because inventory is already appearing at 5,000 in consolidated books. There is no concept of consolidated books, but in the console financial statements, inventory's value has already jumped up by 1,000. So in a sense, I have already recognized that profit in my financial statements, in my consolidated Sir, kaha dikhaya? Dikhaye na. If I did not do that fair valuation, I would have a goodwill. I would have a goodwill of 1,000. Goodwill, no? Yes, I would have a goodwill of 1,000, but because of recognizing this increase, I don't have a goodwill. So therefore, I have recognized this profit already. So therefore, only the remaining 500 is what has to now come. That means your post P&L will face a decrease of 1,000. Itna impact aana hi chahiye. This impact should come in my financials. This impact should come in my financials. 1,000 rupees profit should go down. Now let us come to the process. See, note 1 we will prepare, record all assets and liabilities. Inventory of S to hai nahi, it is sold off. But this 1,000 rupees which was the adjusting entry on the first day, wo abhi bhi hai. I have not yet eliminated it. Now I will eliminate. I know where is this difference. This is nothing but 1,500 minus 500, 1,000. 1,500 profit in standalone S. 500 consolidated profit. The difference 1,000 is this 1,000 which we had recognized pre-acquisition, Cash 5,500. So cash ke case mein nobody has any problem. So if I analyze the profits 4.5 as 3 and 1.5 and take 1,500 into post P&L, the answer is wrong. The answer is wrong because my post profits are not 1,500. My post profits are 500 because I have already taken the inventory to 5,000 prior to acquisition. I mean on the date of acquisition. So therefore 1,000 का impact already जा चुका है वहां पे. हम फिर से 1,500 नहीं ले सकते. 1,000 impact is given as a result of which goodwill does not exist. As a result of which goodwill does not exist at all. And therefore, and it's right, goodwill does not exist is right because you are acquiring a business whose worth is 5,000 and you are paying 5,000 for that. So goodwill will not exist. That is correct. Okay. And that goodwill does not exist because 1,000 is already recognized. So I cannot recognize that 1,000 once again here. I have to recognize 500 only here. So if I have to recognize 500 only, it is a post period adjustment. So my entry will be post P&L account debit 1000. So 1500 S Limited's profit, which is 1500 post acquisition, will come down to 500, which is exactly this figure of 500, which is exactly this figure of 500. अच्छा, post P&L तो सर आपने डेबिट कर दिया 1000. What are you going to credit? What are you going to credit? Sir, in the standalone books, now please pay attention. In the standalone books, कहाँ गया? My COGS or inventory is credited with 4500. My COGS COGS is 4500, or inventory is credited with 4000, not 4500. Inventory is credited with 4000. Inventory gone out, so inventory credit 4000. But in my consolidated, inventory 4000 पे है ही नहीं. Inventory is at a value of 5000. That 1000 increase I have taken on the date of acquisition. So therefore, I cannot credit any other account apart from inventory, because when I'm analyzing the profits of S, I have a post acquisition reserve of 1500. In this post reserve of 5500, inventory is already credited only at 4000. But actually, for consolidation purposes, I should credit the inventory at 5000. Or in other words, for standalone purposes, the COGS was 4000. For consolidation, the COGS should be 5000. That means the cost of goods sold should increase by 1000. And that is why the inventory is going to be credited of 1000. So this is what is going to be your entry in the post acquisition period. In your post acquisition period. उससे क्या होगा? ये जो 1000 rupees का positive impact tha on the date of acquisition, this will now reduce and become 0. होना चाहिए ना? अरे on the date of acquisition, मेरे पास inventory नहीं था. I did not have this inventory on the date of acquisition. On the date of consolidation, inventory is not there. How can I have the adjustment entry relating to inventory? I cannot. For obvious reasons, I cannot. So this has to be eliminated and this becomes 0. So this is going to be my post P&L account debit to inventory. This is what is going to be your impact relating to inventory. Very simple. Now summary of this. How do I do it? Okay, how do I do it? Pre-acquisition impact, the movement in fair value, will be taken straight away to the pre-acquisition reserves. Post-acquisition, if this inventory is sold, the adjustment entry for that increase will be passed through the post-acquisition P&L. Sir, what if this inventory is not sold? Ye inventory stock mein hai. If this inventory is not sold, don't do anything. I say हाथ पे हाथ बैठ के देखने का. Not sold, very good. There is no adjustment that needs to be done. That's absolutely right. It is the adjustment which we are crediting. Inventory credit means the adjustment of 1000. That's right. Okay. अगर ये inventory पूरा साल बिका ही नहीं, if this inventory was not sold, what would be the picture? If this inventory was not sold, the picture would look something like this. Opening stock 4000, closing stock 4000. So P&L would appear at 3000 only, and you would have closing stock of inventory at 4000, and here profits would be 3000. This would not come. And in the consolidated P&L, opening stock of 5000, would appear as closing stock of 5,000. No other effect, because यहाँ पे inventory 4,000 पे आता था and total would automatically come at 5,000. You don't have to do anything. Just fold your arms, look at the adjustment. Inventory is unsold. Stay quiet about it and write down, since inventory is unsold, no further adjustment is necessary. Because 4 plus 1, 5, we've already given this impact on the date of acquisition. Uske baad inventory bika hi nahi. There is no difference in profits, and therefore you don't have to do anything. You don't have to do anything. Okay, so that takes care of the adjustment pertaining to inventory. That takes care of the adjustment pertaining to inventory. Okay, so now let us come to our notes. Let us now come to our notes. Okay, fair value adjustments. Whatever we have discussed so far, everything is there. Plus one extra point is there, which I think you will be in a position to understand. Okay, fair value adjustment. Ind AS 103 requires net assets to be taken over at fair value on the date of acquisition. All of you agree with this. Fair values are not given. It is reasonable to assume that book value equals the fair value. That is normal. However, in case fair values are separately specified in the question, fair value adjustments need to be made. This is because S Limited need not necessarily follow the revaluation model for its assets in its standalone books. ये सारे जड़ का फसाद क्या है? S Limited does not follow the revaluation model. Sir, what if it followed revaluation model? If it followed revaluation model, उसके book में reval reserve आता था ना? You would have a revaluation reserve appearing there. If you had a revaluation reserve appearing there, you would perform an analysis of all the reserves, including the reval reserve. And therefore, no adjustment is needed to be done if the subsidiary also recognized assets and liabilities at fair value. It is not recognizing. It is not mandated to recognize at fair value also. Since it is not recognizing, माँ बाप होने के चलते, we have to recognize at fair value and give the impacts. Okay, this is because S need not necessarily follow reval model. Just because Ind AS 103 requires P Limited to do so in case of business combination. Specifically, only business combination this will be done. Generally, companies will never go for revaluation. It is a plain headache. Okay, you have to get a valuer, do the revaluation, do the adjustments. What are you going to achieve out of that? It is going to be only an accounting exercise resulting in a cost for the company. Otherwise, uska koi value nahi hai. Okay, so revaluations are generally not preferred. Therefore, unless mentioned otherwise, always assumed that S Limited would not have revalued in its assets in the standalone books. However, fair valuation needs to be done in the consolidated accounts, for which following adjustments become necessary. So what are the adjustments? First one, we did property, plant and equipment. Initially, that is on the date of acquisition and post acquisition period. See, first we will compare fair value with the carrying amount on the date of acquisition. On the date of acquisition, it would give rise either to increase in value. If it is increase in value, you would have additional depreciation. If it is a reduction in value, you would have a savings in depreciation. So the entry will be upward revaluation, PP account debit to pre-P&L. This is the initial entry in the consolidated books. Which notes is it impacting? It is impacting note number 1 in the adjustment column and working note for analysis of P&L. So I have given to you where the impacts are going to go. Because of this increase in fair value, additional depreciation will come. That additional depreciation is going to hit my post profits, which is going to go to working note 4 and to property, plant and equipment adjustment column of note 1. We have already seen that. Or if there is a downward revaluation, then pre-P&L to property, plant and equipment, and the corresponding savings in depreciation, PPE account debit to post P&L. This is savings in depreciation. This is savings in depreciation. Okay. So it could be upward with additional depreciation, downward with savings in depreciation. Important point is initial recognition happens in pre. Initial recognition happens in pre-profits, whereas subsequent measurements happens in post. So this is the principle. This is the principle. Okay. Let us move on to the next part, inventory. Let us move on to the next part, inventory. Initial adjustment, upward revaluation, inventory account debit to pre-P&L. Your inventory went up. Because your inventory went up, you are crediting the pre-P&L. Pre-P&L goes to the cost of control account. So the net assets, which is made up of equity plus reserves, that matches the net assets on the date of acquisition as per business combination. That is why we are doing this adjustment. Fair value of inventory needs to be done regardless of whether such inventory is subsequently sold or not. The initial date fair valuation needs to be done whether inventory is sold or not, wo baad ki baat hai. First one is you have to do the revaluation impact because the goodwill should be correctly computed on the date of acquisition. Okay, the goodwill should be correctly computed on the date of acquisition. Later on, if it is unsold, no further adjustment is needed. But if it is sold, you had debited the inventory. In the consolidation adjustment column, you remember I had done plus 1000. And that is why when I do the adjustment on sale, I cannot have this impact anymore. Na? So credit inventory minus 1000. But when are you getting the profits? Post period. So remove it from the post profit and loss account. Okay, so this is where your impacts will go. Acha, downward ho gaya. If there is a downward revaluation, pre P&L account debit to inventory, and the corresponding impact will be inventory account debit to post P&L. Okay, so I have again given where all these impacts will be given. So by the time we complete this chapter, I need you to be perfect in the procedure. Even in your sleep, somebody asks you what is going to be the stepwise model. You have a 6-step model in business combination, and here you have a procedure to follow. Follow that procedure and you will ultimately get to remember the note numbers. Once that is done, any consolidation adjustment you can handle at your end. The next adjustment is payables. Okay, like for example, a contingent liability recognized under Ind AS 103. Same impact, a payable you are recognizing. So pre-payable account, pre-P&L account debit to payable. Subsequent adjustment, payable account debit to post P&L. You can just put this one entry in a box. It's not related to that, but I have just mentioned that adjust against goodwill if it is a measurement period adjustment as defined under Ind AS 103. This is not related to this paid. This is a general note. This is a general note. If it is a measurement period adjustment, it will be adjusted against goodwill. So did you understand? Yes. Did you understand? So these are the impacts. These are the impacts. General rule is given, which will always hold true, Initial changes are done through pre-acquisition reserves. Subsequent adjustment like depreciation, sale or payment of payables, this is done through post reserves. So this is how you will remember it. Okay. Easy to remember. Yes. The concept is what we have discussed in detail. The concept is what we have discussed in detail. So just go through these rules. You should be fairly fine with the rules. Okay. Above adjustment are based on assumption that S has not remeasured its net assets in the standalone financials. If it is given that S has remeasured, then assets liabilities would already appear at fair values. अगर उसने remeasure किया है तो S के books में the fair values would be recorded and you would have a revaluation reserve or a fair value reserve, whatever it is. Okay, so those reserves would be analyzed as pre and post, requiring no further adjustment. Requiring no further adjustment. Have you understood? Yes. Have you understood? Compared to the complexity of the concept, don't you think the rule is fairly simple? Initial changes, pre-acquisition. Thereafter, any changes, post-acquisition. Clear, very clean. Does not require any confusion now. Is it okay? Yes. Are, have you understood? Have you guys understood? Bolo. Clear? Can we give assumption? You don't have to. It is presumed that companies don't follow the revaluation model. It is understood. Okay. So it's not necessary to say that they are what you say, you need not say the assumption that they have not followed. Okay, it is presumed that they have not followed. That is why they are asking you the adjustment. उल्टा मत करना, don't presume they have followed and keep quiet. Okay, उसमें number नहीं मिलेंगे. Whenever you get it, it is with the intention that they have not followed it. Okay, what I want you to do is, I want you to draw a similar chart for payables the way we had done for inventories and understand this concept. See, I leave you with some homework always because I want you to put in equal efforts the way we are putting. Okay, then only the output will be maximized. Okay, so I want you to prepare an understanding of payables the same way we did for inventory. Okay, and when I talk about payables, you can read up the contingent liability recognized in Ind AS 103, which we wrote towards the last session. Okay, you will be in a position to get this, and I think you should get an understanding of this. Okay, so ये concept हो गया, rule हो गया. We are done with the consolidation adjustment relating to fair value, And then what I want you to go through is impairment of goodwill also. It's very simple. Impairment of goodwill means they will tell you goodwill has to be reduced by how much. The impact is इसको लेकर कहां जाओगे? See, goodwill impact is an expense. So that expense will go to the consolidated P&L because goodwill appears in consolidated P&L. But kahan jayega? Well, that depends on partial or full goodwill. Partial hoga, it will be borne entirely by the parent in the consolidated P&L. Full goodwill hai, it will be borne partially in the consolidated P&L and partially with the NCI. So I need you to read note number 2 and come. I also need you to read note number 3, unrealized profit on intercompany transactions. Read it and come. Just read it and come. You have done this in your intermediate, upstream, downstream, these adjustments, you have done it in your intermediate. Okay. Don't read note number 4. It is something new. Don't read note number 4. It is something new. We will be doing that later on. Okay. We will be doing that later on. So I want you to be doing till note number 3. Read it, and if you have the time and the interest, I want you to try to solve question 8. Try. But this is what I'll be solving on Thursday. Okay, but I think you should be in a position to solve it. But एक बार फिर आप try करो, नहीं तो भी I will be doing it in detail on Thursday. Okay, we will not touch goodwill except for two cases. I was always telling that we will not touch goodwill except in two cases. One is measurement period, the other is impairment testing. Sir, why goodwill we will touch on account of impairment? Suppose your subsidiary becomes a loss making entity. Hypothetically, suppose Tata Vistara had to acquire Kingfisher or Kingfisher ki naiya डूब गई. Yes, then how can I carry that goodwill on account of acquisition of Kingfisher? I cannot carry that, and therefore that goodwill will be impaired. Ultimately, you have to pass the test of each asset. Okay, ultimately, when you show an asset in your consolidated balance sheet, that asset must realize at least the recoverable value. And for goodwill, it is possible only if the target entity is a profitable one. That is why we will be checking it on for impairment. Okay, that's the only two cases where you can impact goodwill. Otherwise, if you remember in AS21 or AS14, you were permitted to amortize the goodwill over 5 years or 10 years. वो नहीं है यहाँ पे. That is not there here. You cannot amortize this goodwill. This goodwill will be there only as it is, except for two things. Measurement period adjustment, एक साल बाद वो भी चला जाएगा. So then only impairment testing has to be done on an annual basis. Okay, on an annual basis. Measurement period we had done, no, in Ind AS 103. I had given the concept to you. तब भूल जाते हो. मैंने सिखाया भी गड़बड़ में था. But I had told you measurement period concept. See, where information, see, acquisition happens, but we do not get complete information of assets and liabilities. Then Ind AS 103 allows you to record an acquisition provisionally, and then as and when you get information, you can restate the goodwill. For example, you made an acquisition on 1st March. 31st March ko you have to finalize the balance sheet. Real life is not like academics jahan pe fair value is given, PC is given, everything is given on the same day. ऐसा नहीं होता. In real life, due diligence happens, new facts come to light, तो वो चलता रहेगा. So Ind AS 103 tells us that you do a provisional recognition, and thereafter for 1 year from the date of acquisition, if you get any information which is regarding the conditions existing on the date of acquisition, then you can give the effect in goodwill and not in the profit and loss account. Okay, तो इसको हम लोग बोलते हैं measurement period. इसको हम लोग बोलते हैं measurement period concept. You have to get the data within 1 year from date of acquisition, and it should pertain to a condition existing on the date of acquisition. If both the conditions are fulfilled, you can change the goodwill or capital reserve. If one or none of the conditions are met, then you will have to take the impact to P&L. Nothing will come in goodwill or capital reserve. Okay, so that concludes our session for today. Try to see if you can do that homework what I have told you. Anyways, I'll be solving the problems. Okay, so thank you everyone, and see you guys on Saturday. If you do this homework and the problem, at least I can move a little fast and we can do some more things. Okay, because I see that we'll be able to do only this like 2 hours 45 to 3 hours. That is going to be our timeline. Okay, so revise and come, and see you guys next on this Saturday. Okay, Saturday we have our class. Okay, thank you everyone. Nisarg.